If home values fall quickly, purchasers may find themselves with underwater mortgages, which means they must either stay in the house until the market recovers or sell and lose money. Homeowners owe more on their mortgages than their homes were worth and can no longer just flip their way out of their homes if they cannot make the new, higher payments. Instead, they will lose their homes to foreclosure and often file for bankruptcy in the process. The housing crash begins to take its toll on homeowners and the real estate market. The housing market has encountered significant obstacles over the previous century, but none, with the exception of the Great Depression of 1929, contributed to the decline in home prices that occurred during the Great Recession of 2007. Neither the 20% interest rates of the early 1980s nor the devastation of the savings and loan sector in the early 1990s led to a similar drop in property values. It is also worth remembering that not all economic downturns chill the property market. In reality, throughout the 2001 recession, the housing market and house demand remained strong despite the economic slump. Throughout the course of the last century, the housing market has been subjected to a number of significant obstacles, but, with the exception of 1929's Great Depression, none of these problems have resulted in a decline in home values on par with that of 2007's Great Recession. The interest rates of 20% in the early 1980s and the devastation of the savings and loan business in the early 1990s did not lead to a similar drop in the value of homes. It is also important to note that the housing market is not always affected negatively by recessions. Despite the fact that the economy was in a slump during the recession that began in 2001, the housing market and demand for homes continued to be healthy. The previous housing bubble in the United States in the mid-2000s was caused in part by another bubble, this time in the technology industry. It was intimately tied to, and some believe was the cause of, the 2007-2008 financial crisis. During the late 1990s dot-com bubble, many new technology companies' stock was purchased quickly. Speculators bought up the market capitalizations of even firms that had yet to create earnings. By 2000, the Nasdaq peaked, and when the tech bubble burst, many high-flying equities plummeted. After the dot-com bubble bust and stock market crisis, speculators fled to real estate. In response to the technology bust, the U.S. Federal Reserve lowered and maintained interest rates. This rush of money and credit met with government programs to encourage home ownership and financial market developments that improved real estate asset liquidity. More people bought and sold homes as home prices soared. What happened to homeowners when the housing market crashed? In the next 6 years, the homeownership craze developed as interest rates fell and lending standards were relaxed. An increase in subprime borrowing began in 1999. Fannie Mae made a determined attempt to make home loans more accessible to borrowers with weaker credit scores and funds than are generally needed by lenders. The intention was to assist everyone in achieving the American dream of homeownership. Since these customers were deemed high risk, their mortgages had unconventional terms, such as higher interest rates and variable payments. In 2005 and 2006, 20% of mortgages went to persons who didn't meet regular lending conditions. They were called subprime borrowers. Subprime lending has a higher risk, given the lower credit rating of borrowers. 75% of subprime loans were adjustable rate mortgages with low initial rates and a scheduled reset after 2 to 3 years. Government promotion of homeownership prompted banks to slash rates and credit criteria, sparking a house-buying frenzy that drove the median home price up 55% from 2000 to 2007. The U.S. homeownership rate had increased to an all-time high of 69.2% in 2004. During that same period, the stock market began to rebound, and by 2006 interest rates started to tick upward. Due to rising property prices, investors stopped buying homes because the risk premium was too great. Subprime lending was a major contributor to this increase in homeownership rates and in the overall demand for housing, which drove prices higher. Borrowers who would not be able to make the higher payments once the initial grace period ended, were planning to refinance their mortgages after a year or two of appreciation. As a result of the depreciating housing prices, borrowers' ability to refinance became more difficult. Borrowers who found themselves unable to escape higher monthly payments by refinancing began to default. There was an increase in the number of foreclosures and properties available for sale as more borrowers defaulted on their mortgages. A drop in housing prices resulted in lowering the equity of homeowners even more. Because of the fall in mortgage payments, the value of mortgage-backed securities dropped, which hurt banks' overall value and health. The problem was rooted in this self-perpetuating cycle. By September 2008, average U.S. property prices had fallen by more than 20% since their peak in mid-2006. Because of the significant and unexpected drop in house values, many borrowers now have zero or negative equity in their houses, which means their properties are worth less than their mortgages. As of March 2008, an estimated 8.8 million borrowers, 10.8% of all homeowners, were underwater on their mortgages, a figure that is expected to have climbed to 12 million by November 2008. By September 2010, 23% of all homes in the United States were worth less than the mortgage loan. Borrowers in this circumstance have the incentive to default on their mortgages because a mortgage is normally non-recourse debt backed by real estate. As foreclosure rates rise, so does the inventory of available homes for sale. In 2007, the number of new residences sold was 26.4% lower than the previous year. The inventory of unsold new houses in January 2008 was 9.8 times the sales volume in December 2007, the highest value of this ratio since 1981. Furthermore, about 4 million existing residences were for sale, with around 2.2 million of them being unoccupied. The inability of homeowners to make their mortgage payments was primarily due to adjustable rate mortgage resetting, borrowers overextending, predatory lending, and speculation. Once property prices began to collapse in 2006, record amounts of household debt accumulated over the decades. Consumers started paying off debt, which decreases their spending and slows the economy for a prolonged period of time until debt levels decreased. Housing speculation using high levels of mortgage debt drove many investors with prime quality mortgages to default and enter foreclosure on investment properties when housing prices fell. As prices fell, more homeowners faced default or foreclosure. House prices are projected to fall further until the inventory of unsold properties, an example of excess supply, returns to normal levels. According to a January 2011 estimate, property prices in the United States fell by 26% from their high in June 2006 to November 2010, more than the 25.9% decrease experienced during the Great Depression from 1928 to 1933.